All right, everybody. So we'll be going over the market as well as a couple of topics. All right. So the first topic is what you might have heard called protected highs and lows. Protected highs and lows. So I've heard this term, and I don't know how they defined it. I could care less because the way this is just support and resistance, but it's a certain type, meaning when you have the impulses, right? Right? The reason why this low was not taken out is, I guess you could call it protected if you want. Right? So this is just the origin of the rally. All right, origin of the rally, and I'll explain why it's quote unquote protected. This is the origin, what the hell? Origin of the rally. All right. The origin of a rally. Okay, let me take a step back. First of all, there are no protected highs or lows on lower time frames. All right, no such thing. This is just an opinion, but from what I've seen, there's no such thing as protected highs or lows on lower time frames. Yeah, especially in the ES, because the lower time frames have too much trading noise coming from higher time frames. What I mean by that is, let's say you have a 1 minute chart, right? There are people trading on the 3-minute chart, the 5-minute chart, the 15-minute chart, the 30-minute chart, the hourly, the 3-hour or 4-hour, then the daily. There's so many higher time frame traders that it's just too much trading activity for there to be clear structure. All right, so it's like you have this time frame and that time frame and that time frame and that time frame and that time frame. All these traders. So let's say you have 5-minute, 15-minute, 60-minute. You know, you have 180 or 240. You have daily that may be entering. Then you have all of these time frames, right? Oh, I forgot the 3-minute, but we'll just put 3 minutes. You know, on that 1 minute. So there's too many people, too many traders. This guy's gonna enter, this guy's gonna enter, and they don't have just one order, they have a lot of orders. So this is going to make the 1 minute chaos, right? That's why lower time frames are like 5-minute, any minute-based time frame, like the 1, 3, 5, 2, whatever, is for entry, not for structure. All right, because there's too much chaos on top of it. There's just way too much. And there's also a lot of algorithms and stuff like that are operating on these time frames. So regarding the protected highs and lows, you need a higher time frame. Is the origin of the rally on on higher time frame. So nothing lower than the hourly. Nothing lower than the hourly. Zoom back in. What I did. Anyway. All right. So this is the idea of protected highs and lows. So now I'll give you examples, right? This is the rally. This is the down rally on the hourly. On an hourly, this high is protected. You consider it protected, but it's also going to be targeted. Let me just say that by the daily, because the daily is in the opposite direction. However, on this time frame, this is the protected high, because it's the origin of the rally from which one red came from. So this is just a heavy, a point of heavy supply, right? Now, the thing is that although it's quote unquote protected, you have an uptrend, so it might try to target it. But this area right here, it's not easy to get above this area. Okay? On a daily, these lows, this is the low of the rally, protected. Low of the rally, protected. So how do you know it's a rally? You have green, 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 and then you have a breakout bar. Green, 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 breakout bar, follow through with trend, protected. Okay? Now, that's all. That's really it. I mean, you know, I'll show you this entire trend, how it's quote unquote protected. All right? This is the low, the rally, the low before the rally doesn't break that area. 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 Low before the rally breaks that area. That's a structural shift and a trend break. This is a trend break, and this bar is the bar that broke the back of the uptrend right here. Why? Because it broke the origin of the rally, right? From which there was a rally that had a breakout in it with follow through. When that breakout is negated and the low is taken out, it's game over. And also note how the low is taken out. The low is taken out with a big bar. This is a breakdown bar. This is a bar that breaks the trend of the uptrend, the back of the uptrend right here. There's a backbreaker bar, boom. All right, and then it just goes down. All right, and this is the origin of the rally, the protected high, and we'll see if if they're going to break it. If they break it, it might just reinitiate the uptrend, and then you'll see protected lows instead of protected highs. All right, so that's the point of the protected low and highs. It's just the origin of the rally. That's all it is. Why is it protected? It's because it's a point from which heavy demand or supply came from. And the only one that can do that is smart money. It's not a small outfit. It's big money pushing. Like this bar is the biggest bar in 100 bars. Who can do this bar? This is not something normal traders can do, especially on the ES. That's why this high is protected. All right. Now that doesn't mean that it can't be taken out, because there are daily traders that eventually will take it out. But it's a good, if you have like a pullback, that's supposedly where the stop should go, right? Because it's quote unquote protected. There are times when it will get tested with a spring or an upthrust, but most of the time it doesn't go that far. All right. What you want to see for a trend resumption is a breakout above that high to say now we are back in an uptrend and this down rally pullbacks are completed and this down rally is now going to be replaced by an up rally. All right, so I've gone over that. That's really important to understand protected lows and highs. Why is it important? Simply because the stops should go at the protected lows and highs on whatever time frame you're trading. That's where the stops go. That's the first reason. And the second reason is when that quote-unquote protected low is taken out, especially with a big bar with big range that looks like a breakout or breakdown bar, then that trend is in jeopardy. And you want to see if there's follow through such that it changes the entire trend from up to down or from down to up. If this level is taken out, which level? Like I think it's a 50-40 level, 5040. If that's taken out, and I want to see how it's taken out, if it's taken out with a big bar, then the rallies will establish themselves and the trend will establish itself. Otherwise, at this area is typically defended. This area is typically defended. Why? Because it puts the trend intact. Okay. Just like on the daily, this area is defended, this area is defended, this area is defended, and chances are price won't even go that low. It'll go like 50% or something like that, test a breakout, and then reverse. All right. So we have to see if this correction on the daily, which looks like a rally on the hourly, is over or not. Now, as far as the minute-based time frames are concerned, I explained that there's no protected high or low. So you'll see like sometimes it looks like it's quote-unquote protected, but a lot of times it's just not as reliable. Not nearly, the higher the time frame, the more reliable. All right. So like this low after that breakout rally is protected here. Tap 1, tap 2, tap 3. This one could not break that low, right? And if it does, if it takes that low out, the trend changes. And if it takes out that high again, trend changes again. You know, but again, I don't, forget the lower time frames. Using them for structures, it just doesn't make sense. Use them for entry, the higher time frame for structure and location. All right. All right. Now let's go back to pullback. So I've been discussing pullbacks, and we're going to go into it a little bit more. But first thing to note, that anytime you have a pullback, there are a couple of levels to note. All right. That level right here of the prior high. All right. Now, if you have a prior high that's pretty high up, like here, then in this case, you want to focus here on the demand zone. Okay. In the case that there is a lot of follow through, you use the high as a support level. In case there's not a lot of follow through, you use the low bar, the demand zone, as a support area, given that both of these are rallies. Rally. Given both the rallies, depending on the amount of follow through, either this high will become a support or this low pivot area will become a support. Okay. So this gives you two locations that you must know based on the amount of follow through. So here is a testing criteria. You can use this for yourself. All right. Now, in the first scenario, and this is the objective criteria I'm going to give you now. The 50% retracement is greater than the prior high. When the 50% retracement when the 50% retracement is greater than the prior high, then the prior high is very likely to become resistance. All right, because it'll get exhausted by the time it gets below. All right. If it's not, right, let's say it's above, right, let's say it's over here. Then the price is going to test low, the pivot low. All right. So this gives you an objective criteria to identify support levels based on how much follow through. And one way to measure that is you just use a 50% retracement. If the 50% retracement is above the prior high, the likelihood of this going to the prior high and then rejecting is good, because the prior high is going to serve as a support level. If the 50% retracement is lower than the prior high, then chances are, if the trend is going to maintain, that pullback is going to test this area, which is the pivot or the order block or whatever you want to call it, demand zone, etc. Okay, so this is very important objective criteria, all right, that you can use for even automatically having your support and resistance automatically drawn on your charts, yeah. All right. Next, so now you know where to look for trades. This is why it's important. I'm not just doing this for no reason. This is where you know to look for trades, here or here. When to look for trades here and when to look for trades here. Okay? This is why it's important. It gives you trade location. And two of the key locations are indicated. And we can test this right now on the current market. So we'll just take the whatever this trend here. All right. Oh, one other thing I have to mention. So this is 1, this is 2. The only time, not the only time, but a third possibility in strong trends is you might just get a spring. A spring and yes, this is a spring. All right. It doesn't always have to be at the extreme low of a range. It springs this low. A spring, right? So this you have scenario 1, it tests the prior high. Scenario 2, it tests the low, area or the pivot area or the demand zone. Scenario 3, you just have a spring and you go. So these are the 3 major price-based scenarios of where to find trades on a pullback. Where to find trades on a pullback Gives you these three scenarios. And now we'll put it to the test. We'll just take the, just the uptrend. The price goes up, down. It's in the spring position. You might say, why is it in the spring position? This is just a deep shakeout spring. But it's a spring nonetheless. Why? After the bar breaks the low, it has no follow through. And there's a green bar right after it. So that's telling you something. If it has no follow through and it overlaps here, then it's in spring position and boom, goes right back up. Second, so this is scenario 3 that I just covered. This is again, you had a minor spring here that tested the, what is it called? The creek. This is scenario 1, tap, tap. It didn't work. So what happened? It went lower. And you went to scenario 2, which is a test of the pivot, the low bar, which is right here. I can't move. All right. Here, again, you have the low bar and you have a spring situation, tap, and right here. Here you just have a spring situation. It does not test the low bar. It does not test the prior high either. Why? Because it's a spring. Spring scenario 3. Here it tests the low bar. Actually test this high right here. Test both. And finally, it does it again. But this time, this low before the origin of the rally is broken by this bar. What does it tell you? Trend break. Bingo. Right? Trend break right there with authority, and it just breaks down. All right. Now, what we're doing is we're trying to figure out, if this thing is going to make another leg lower. We're trying to figure out if this thing is going to make another leg lower, because we have a very clear rally that goes down, and you have these retracements. Now you're probably wondering why these retracements are pulling back all the way. It's because of a daily uptrend and a very strong daily level here. There's a daily volume level here, and if you see what happened, as soon as it tried to go below it, it went above it on the biggest bar in 100 bars, and that initiated the counter trend back up. So now I want to see how it reacts here to see if the daily trend takes over and makes a higher high, or we're still in a corrective action on the daily with a follow through to the downside on the hourly. So we'll see what's going on, and be coordinating this with the minute-based charts with the levels that you already can see are marked, and that's it. All right, folks. So key takeaways: protected lows and highs are just highs and lows of the rallies, the origin of the rally, meaning where the rally started from. That's a protected low, and a protected high for a down rally. The start of the rally is the quote-unquote protected low or high. All right, this is my opinion. This is what I see in the market. Doesn't mean there's a definition out there, but this is what I see. All right, so it's just an opinion, but you can check for yourself. The second thing is those lows or highs, when they're taken out, you need to see if they're taken out with authority, meaning a big bar breaking that quote-unquote protected low or high. If so, chances are you have a trend change. That is the real break of structure. I know there's a lot of stuff out there that just shows you a high or a low that's broken. Those high lows don't mean nothing. It's whether the origin of the move, the origin of a heavy demand or the origin of a heavy supply, and within that trend, if that breaks with a big bar. All right, so that is your trend change break of structure. All right, and then the third thing has to do with the pullbacks. So I've given you 3 price-based scenarios. Scenario 1, the market pulls back to the prior high within an uptrend. This is the case when you have a 50% retracement that's above the prior high. Then the prior high becomes an excellent area of a support level. If the 50% retracement is below the prior high, then the bar near the low pivot, the quote-unquote demand zone area, extreme low area, that becomes your potential support. And you have to see how price moves as it gets there. So third scenario is that market pulls back, but it's pretty strong and it doesn't pull back enough to the prior high or the low. So it's not pulling back to the prior swing high. It's pretty strong, and what'll happen is you'll have some corrective action, possible spring, and it'll just continue from there. So these are three scenarios, and they teach you the first two about going to the prior swing high on a pullback, and the other one, which is going to the demand zone. These are price-based scenarios that can be planned for in advance. The third scenario, you don't know if it's when that spring is gonna happen. It just happens. You can't really mark the level in advance. It may happen, may not happen. You can after the first pullback. If there is a first pullback, then you can draw the low and then kind of plan for it like that. But these are just the more important point is to constantly be ready for these situations so you can execute off them. All right, I'm done. Have a good day. Bye.